I've got a good top 10. Maybe we can have the audience participate. But our 50th episode is coming up. Maybe the top 10 locations of where we should film live our 50th episode.
Ooh, that would be good if we could throw it up there and people could vote for it.
Let's do that next week. Let's get some comments down below. I'm shooting for Vegas, or actually Tennessee's not a bad. Nashville's not a bad location either. Cancun, Cabo.
Yeah, when we got 2 East Coast guys, 2 West Coast guys too, so they're going to be button heads. So it'll be interesting where it comes out.
Welcome to Drunk Real Estate.
Grab a drink and enjoy the show.
Hey there, welcome to episode 44 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband, and the gang's all together here. We got all 4, including Mauricio Rauld. How's it going, buddy?
It's going good. And super pumped because I don't know. I'm wearing the black shirt again, as you can see. I'm bringing it back.
To bring it back, I heard it was one of our highest viewerships ever. So that it was probably just because of the open black shirt and the freshly waxed chest.
Yep, the freshly waxed chest apparently was a good for the audience, and I wasn't quite sure if it was my waxed chest or AJ's hairy chest, but we're gonna find out today because he's not rocking the black shirt. So if we do well again, that means it's my shirt. If we don't do well, then it was obviously AJ. So we'll find out today.
Well, I actually saw that poll on Instagram, and the hairy chest won out. So, what are you drinking, Mauricio?
Dude, you are going to be pumped about this. For some reason, actually, I do have a good reason. I'm actually on a mini cut right now because I don't know, I'm in a cut mode, and so I'm trying to limit my calories a little bit. So instead of doing the wine, I'm actually doing a little bourbon there for you, a little Woodford Reserve, a la Kyle Wilson. Because I saw this at the store, and I'm like, in honor of my buddy Kyle Wilson, I'm going to drink a little Woodford Reserve, and it is woo. I picked a good day to pick a complicated topic to try and digest.
That's a little mini bottle there too. I still have mine from the week before still sitting here. Look at the size of mine versus yours. And this isn't even the biggest one.
Dude, it's not all about size, Kyle.
That's what he wants you to believe.
Jay, how's it going, man?
I'm doing well. I'm not rocking the Woodford Reserve. If I would have known, I would have gone out and gotten some Woodford Reserve.
They don't sell it at Costco, Jay. Sorry, they don't sell it at Costco.
I have a Total Wine near me. I can sneak in every once in a while as long as the Costco people don't see me. Are you gonna ask me what I'm drinking?
What are you drinking, Jay? I just thought you were just going to keep talking. You were talking about what you were drinking and you weren't drinking. And so I just thought you were going to keep going. I didn't realize you have to ask me if I'm going to answer.
I'm sorry. I have no good stories for this week, so I'm just jumping right to what I'm drinking. I am drinking.
Wait, for this week or in general?
In general. So my wife.
What the hell is that?
I have no idea where this came from, but I said to my wife, I want a vodka and soda, and I couldn't find the vodka, and she's like, "There's a blue container in there," and so I went in the cabinet and some Ocean Organic vodka. And I have no idea what it is, and it's not bad. I mean, it's vodka. I can barely taste it, but I'll let you know how strong it is in a few minutes.
Costco is really getting on the cheap side over there. I mean, it's like no name vodka over there at Costco.
Is that not good stuff? I assumed it was probably decent.
You just said it doesn't. What did he say? It doesn't taste terrible or something. That's the kind of the standard that I'm always looking at. It doesn't taste. I used to ask my dad all the time. He'd be like, "Hey, what do you think of this wine?" He's like, "Oh, it's drinkable." Like, that's not exactly a ringing endorsement.
Yeah, but with vodka, actually, the hallmark of vodka is the better the vodka, the less you could taste it. So maybe it is really good vodka. He just can't taste it.
Or you could drink water.
AJ, how's it going, man?
It's going in Nashville.
Nashville, yeah. You in a hotel room right there right now, or what?
I am. You can tell by the 80s painting in the background here.
Couple of beauties up on the wall there. Did they bring Diet Coke with you, your assistant, for the hotel room for the podcast?
So I'm actually going super fancy today. So I've got strawberry lemonade, freshly handcrafted. Look at that.
Wow.
Yeah.
Wow.
I know. Super fancy.
Well, it must be a special episode then. We appreciate it. Well, I had planned on, so like Mauricio, I'm not cutting, but I'm trying to watch what I eat. And it was my daughter's birthday, so shout out to my daughter, 9 years old today. And and so I had a little bit of cake, and it threw all my macros off. My carbs were pretty high. So I tried to go with the zero carbs. So I went with the clear rum. I was grabbing that. It's got the got the American flag on the back, homegrown. But then I don't know what I should do, because then Mauricio just threw out that there was Woodford, and I actually, it's still sitting on my desk. So I don't know if I should switch back to it, but I think I'm going to still go with the clear tonight.
What happens if you mix it?
It's the worst idea ever. What is this, college? You making some jungle juice over there? You guys ever used to have that in college, a jungle juice? Oh, we crush it. You get the big Gatorade containers, like from the football, and like the big orange containers, and then you just throw a party, and then whatever alcohol is left over, you pour it all in there with some like high C and like frozen concentrate orange juice and stuff, and then just serve it the next day for another party. It was great. No, just me. All right. Let's get into this. Let's talk about the US dollar. We've talked about it quite a bit on this podcast, but the concept of the US dollar dominance has been discussed in length. But recently, Mauricio brought up the concept of this dollar milkshake theory and the book it was based upon. So as US based investors, it's sometimes easy to get tunnel vision and only consider US assets. But with everything going on geopolitically, it may be beneficial for us to step back and look at the broader picture. So, Mauricio, what does the dollar milkshake theory say? And what does it tell us about whether we should be concerned about the US dollar or not right now?
I'm glad I picked this topic after a couple glasses of this hard alcohol. But so look, as most of you probably have noticed, that the dollar's been going up recently. Obviously, there's a lot of geopolitical stuff, but also gold has been going up, which is a little sometimes counterintuitive when you see the dollar going up and gold going up. And so I wanted to talk about this dollar milkshake theory, which I want to give full props for the author of this, which is Brett Johnson. Brett Johnson manages a fund over at Santiago Capital, and he came up with the dollar milkshake theory, I think about 4 or 5 years ago. I think it was like around 2019, maybe a little bit earlier than that. And it's kind of his framework for, he believes there's going to be a sovereign and currency crisis, which essentially means that he thinks the dollar over the next several years is going to really go up a lot, which is going to cause a ton of issues. And just so we don't leave anybody behind, when I say the dollar is going up, a lot of people think that that's good, or some people think that's bad. I think by the end of this dollar milkshake theory, you'll realize that it's not exactly a good thing. But all we're talking about with the dollar getting stronger or the dollar going higher is in relation to other currency. So the dollar versus the yen, or the dollar versus the euro, or the dollar versus the peso. As the dollar goes up, what that means is that the other currency goes down. That's all we're talking about. We're not talking about inflation. We're not talking about anything else other than what is the value or the price of dollars when you price it in other currencies, right?
And you could track that using DXY, right?
Yeah, generally speaking, if you want to find out what the dollar, I don't even know, I didn't even check it this morning, but if you're looking at what the price of the dollar index is, that DXY, which is the dollar against a basket of currencies. It's weighted differently, but it's primarily, I think it's the yen, the euro, and there's one other one that I'm escaping that is kind of the vast majority of that basket. But the dollar strength or the dollar weakness, when I say that, we're talking about how it relates to other currencies. But Brent, is it about 5 years ago now, came up with dollar milkshake theory, and what he observed was like after 2009, right? We had the great financial crisis of 2009, and what happened is that all of the central bankers, remember what they all did? They just flooded the world with this liquidity, whether it's money printing or bailouts or stimulus, whatever you want to call it. Every single country out there just flooded the market with liquidity. A lot of people give the US a lot of slack for basically printing all this trillions of dollars or whatever. But in reality, all the other currencies, all the other governments have done just the same thing at equal or greater rates. But the bottom line is that you have all of this excess liquidity or additional liquidity that's hit the market. And that is kind of the milkshake that Brent talks about in his analogy. When you think of this milkshake and the dollar milkshake theory, that is all the different currencies, all the dollars that have been put in the system, the yen, the yuan, that's the other currency I was missing, the yuan, the euros, all these currencies have been flooding the global market since 2009 to kind of basically fix this currency or this crisis that we had in a global financial status. And what Brent's thesis is that, and when he came out with this in 2019, interest rates had gone to zero, had been zero for a long time, and they were starting to come up again, which was causing some issues. But his theory back then was that this 40-year bull run of bonds, where interest rates were basically down to zero, was coming to an end. And you were going to start seeing interest rates going higher. And Brent's theory is that because of the U.S.'s position in the global markets, we obviously have the global reserve currency. We're one of the largest consumers in the world. We have advantages over other countries, whether you like it or not. That's the reality. And so the U.S. is going to be able to increase rates relative to other countries at a higher rate. So, and we've been seeing that actually since the last 2 years, right? So we're able to increase interest rates because if the shit hits the fan, then we're able to print our way out. We're the only one that can really we can print our way out of stuff. So when interest rates go up, we can handle that versus other countries. They can't afford to raise interest rates because their economies collapse, right? They can't sustain that higher interest rate. So Brent's theory is that relative to other countries, the US will have higher interest rates than everybody else, which will cause all of that excess liquidity to basically be sucked up. That's kind of the straw. But all of that liquidity, all that money that's been printed since 2009 will be making its way over to the US because of the higher interest rates, because of the demand for the dollar. And so that money will leave the other countries, will go to the United States, which will increase, obviously, the demand for dollars. Because if you want to buy treasuries or you want to buy anything in the US, a stock market, real estate, what have you, you've got to first convert that into dollars. So the price of dollars will start to go up, which puts an incredible amount of pressure on the rest of the world. So the dollar going up is nice for us, especially if we're going to go visit another country. Like if I go over to Kyle's neck of the woods and dollars increase vis-a-vis the Canadian dollar, which actually has happened. I was up in Canada a couple months ago, and everything was probably 20% cheaper than I was expecting because the dollar is strengthened vis-a-vis the Canadian dollar. But as that happens, because everybody transacts in dollars, because not only to buy commodities like oil and soybeans and all this stuff has to be bought in dollars, but even the debt, right? We always talk about debt. In order to get debt, if you're a company in Brazil or in India and you want to grow your business, you're going to get debt. You're going to pull out a loan, and you're going to pull out a loan in U.S. dollars because you get a much better rate. Like if you want to borrow Argentinian pesos versus U.S. dollars are going to lend you at X percent, and pesos are going to lend you at 3X percent, right? So it's much cheaper to borrow in dollars. And so that means your interest payment, your mortgage, if you can think about it as your mortgage or just any interest payment, will be denominated in dollars. And so when the price of dollars goes up vis-a-vis your currency, that means the cost to service that debt for you, that if you're in India or Brazil or some other country, also goes higher. And so it puts a tremendous amount of strain on foreign corporations and foreign business people because just the amount of debt that they have to sustain, their interest payment suddenly goes up by 10, 20, 30, 40% and puts in a ridiculous amount of strain, which actually is kind of a self-perpetuating problem because as the dollar keeps going up, these countries have to start printing their own currencies in order to buy more and more dollars. And so if you're there in Japan and you've got your yen, and you have to print more and more yen to buy the same amount of dollars, well, that weakens your currency vis-a-vis the dollar. And so that strengthens the dollar even more. And it becomes this cycle. It's almost like a death spiral as the dollar keeps going up. And we saw a little bit of that not too long ago, like right after COVID, when everything was going south, we saw the dollar rise significantly. I think it got up to, Jay, you can correct me if I'm wrong, I think it got above 120 actually, maybe 120, 125. Now it's back down to 105. And that's kind of Brent's theory, is that he believes the dollar will continue to go higher. Now, the U.S. can manipulate that. They can control that to bring it down because contrary to popular belief, the U.S. likes a strong dollar in some areas. But if the whole system collapses because the rest of the world can't sustain the higher dollar, that's not good for anybody, right? And so the U.S. will often intervene and sort of ease the pressure for the dollar. But ultimately, Brent's position is that over time, over the next, it's actually taken longer than he originally thought, and he's admitted that. But over the next 2, 3, 4, 5, 6 years, not 10, 20, 30 years, but over the next 3 to 5 years, you're going to see the dollar strengthen. You're going to see all that money flooding into the United States, which will prop up sort of the blue chip stock market, will prop up real estate, which is, I think, a good connection to us. So I'll wrap it up here. But the bottom line is that, as the currency in other countries goes down, people want to preserve their purchasing power. So they end up buying U.S. assets, whether that's real estate, whether that's straight up the dollar, whether that's treasuries, whether that's the stock market. And so Brent's thesis is over the coming years, you're going to see a sovereign debt crisis, a currency crisis, which ultimately will result in having to reset the entire system. Because even though it's good for the US in the short term, which is why he thinks US denominated debt is going to rise, including gold, by the way. He does think gold at the end of this process will rise alongside the dollar, which is actually, interestingly enough, which is what reminded me of this theory, has been happening over the last 2 or 3 weeks. You've seen the dollar strengthen and also gold strengthen, which is usually counter-cyclical, because as the dollar gets stronger, usually the gold gets weaker. But both have been rising. As we know, gold hit an all-time high a couple of weeks ago, and dollar isn't anywhere near all-time high. But anyway, so I thought that's just an interesting framework because it obviously doesn't affect people. You see a lot of people saying that the dollar, it's the end of the dollar's going to collapse. And if you believe that, you're going to have a certain investment thesis. But if you haven't heard of the dollar milkshake theory, I would highly, highly encourage you to just Google it. Brent Johnson came up with it about 5 years ago. And it's just another perspective that maybe the dollar isn't going to be over here in the next 2 to 3 years. And it's the end of the world, but it's going to be actually the opposite. And that does have an effect on your investment thesis.
It's an interesting theory. Like when I looked into it, where we always talk about like the death of the dollar, and we usually look at it, the death of the dollar as in it weakening, right? As it getting weaker. But this theory is almost the opposite, that the death of the dollar is going to be that the dollar gets too strong and basically everybody else revolts and has to reset the whole monetary system because the US dollar has become too strong and too dominant. And basically everyone says we can't handle this anymore. So like it was an interesting concept. And the more you listen to it, the more it makes a lot of sense.
Well, Brent, one real quick point, Jay. Brent's main point there is that even though it's true that the U.S. is either just printed a bazillion and trillions of dollars, so has the rest of the world. So anything you're thinking the U.S. is going to have a problem with, the rest of the world is going to have that problem first. If the U.S. can't borrow for some reason, which is what a lot of people think is going to say, then the Brazilian entrepreneur for sure won't be able to borrow. Like the U.S. would be the last one to fall, so to speak, and everybody else is going to have issues way before the U.S. has any issues. But Jay, go ahead.
No, and I think that's the key is that the end game here is going to be bad because it's bad for everybody. So if all other currencies collapse, the U.S. is going to be forced. And Kyle used the term revolt. I think it's less of a revolt and more of the U.S. will unilaterally decide that they need to fix the global economy or the global currency. And to do that, they're going to have to reset the dollar. They're going to have to devalue the dollar, which ultimately is going to crush hard assets in this country. It's going to hurt the stock market. It's going to hurt real estate values.
How would they devalue our dollar, though? I guess that's the thing, because when you think about what are the things that would devalue our dollar, and we talk about all this stuff that could devalue our dollar, mainly like printing money or like these crisis moments, as Mauricio points out. Like if you look at 2008 to now, we've done everything in the book that should theoretically devalue our dollar, and it's gone up by 25%. So like, what's going to devalue it?
Well, I think that's the point of this theory is that there's not a lot we can do without doing stuff that's drastic. The most drastic thing I can think of is we basically we forgive debt. So we basically say to these other currencies, hey, you owe trillions or hundreds of billions, which is a huge amount of money in emerging markets. We say, hey, instead of you having to pay back all this money you owe, we're going to forgive that. And now suddenly that frees up a lot of this other currency to be used for more domestic purposes or to borrow more dollars or whatever it is. But that's going to devalue the dollar relative to that currency because it's strengthening that currency. It's forgiving debt. It's reducing payments that are needed to be made against the dollar in that denominated currency. And so whether I'm sure there's probably other things they can do, but off the top of my head, that's the first thing I can think of. Now, the big question I have is what's the timeline for something like this? And I listened to Brent and this was, I think, 2019, and it's unclear if he's talking about 2 years or 5 years or 50 years. He certainly has gotten a couple things right. I mean, if you look back since 2019, we've seen the Argentinian peso has basically gone to crap. Turkey currency has gone to crap. The yuan is dropping. We've seen the euro to some point in the last 4 years be depegged from the dollar. I mean, he's gotten things right. And so, and I'm not saying that the gold increase over the last couple of weeks is directly related to that, but part of his hypothesis was that, like Mauricio said, while gold and the dollar are normally kind of conflicting assets, when one does well, the other does poorly. His argument was, as there's this fleet of liquidity, people are going to be moving money, or as there's this increase in the need for the dollar, people are going to be moving to the dollar, and at the same time, they're going to be moving to gold, because gold is that one safe haven. In addition to the dollar that's highly liquid and largely risk free. And so the question is this a 5-year thing? Like, are we near the end of this cycle, or is this a 20 or 30-year thing? And yeah, we can keep this in mind, but we've got another couple decades before we need to worry about it.
Yeah, and it's interesting because remember when we say the dollar is strong, it's all relative, right? Like the dollar could be falling 50%, but if the yen is dropping 60%, then the dollar is going higher, even though it's dropped 50%. So when you think about it in relation to gold, I think that's where you could see both the dollar and gold rising. That would make sense, because the U.S. dollar is just the cleanest, dirtiest shirt, as they like to say, because if it just, as long as it drops and falls in value less than the other currency, we're in good shape. The other thing they could do, Jay, in terms of, is they could come up with a new reserve currency, right? And it doesn't have to be a completely new one. It can still be primarily dominated by the US dollar, but they could sprinkle in other things. And I think that's where the gold bugs get all excited. And they're like, oh, well, the new standard is going to be, gold standard or a partial gold standard. They go all excited. I don't think that's going to happen. But that's the other way they could alleviate some of the pain, is to come up with a new currency, a new reserve currency that weakens the dollar a little bit. And the last thing I'll say, and then I'll turn it over, interested in AJ's thoughts here as he's enjoying Tennessee. But Brent originally, he's admitted, it's taken longer than he thought. So this is not a 10, 20, 30-year problem. He thought when he first said it that it would be like a 3 to 4 year thing. Like when he originally said it, he thought it would already happen by now. And obviously he admits he's gotten the timing wrong. And so I've heard him now say, another 3 to 4 to 5 years. But it's certainly not something in decades. I mean, I don't think Brent's a betting man, but I'm guessing he would say by the end of this decade, you'd have an issue.
And he didn't really get it wrong. I mean, maybe he got the timing wrong a little bit, but part of that theory is, as money is flowing into the dollar, as the dollar is strengthening, we're going to see dollar-based assets increasing. Well, what have we seen with the stock market over the last couple of years? What have we seen with real estate over the last couple of years? We can argue that maybe that was more COVID related, other supply and demand related, not directly related to the dollar. But barring any other evidence, there's no reason to believe that dollar strengthening hasn't led to these other hard assets increasing. Here's the other thing, and I'm sorry, I'm going to let AJ talk first, and then you can come back to me, because I know he hasn't said anything yet.
Well, I think that the key thing that we're going around is, honestly, the one thing that matters is what happens with the other countries. So the dollar is the dollar because everyone believes in it. That's it. It's the only reason. So we could print all the money in the world, and we could destroy our own currency. But at the end of the day, if everybody else is in ruins and we have food, oil, water, and we have an army to protect everybody, we can still dictate terms, and everybody needs our dollar. Now, that's not saying that would be good, obviously. We would end up in wars, and you'd have to kill a lot of people to prove it and everything else, right? That'd be severely messy. But the point being is that at the end of the day, when the world falls apart, if we're the ones standing and we're the ones holding everything, people will still use us because they need debt. They need all those things. So that's why we're originally in the spot. Now, if a bunch of countries came together and were super strong, right, and everybody stopped wanting dollar and everybody trusted those other countries, if they even had the power to do so, right, when we look at that, that's when that becomes an issue, right? There has to be a viable option. And until there's not a viable option, whether the dollar gets strengthened or gets less, we have to get really into some scary places for that, to people to drop the dollar. Like, I mean, really scary. You're talking about we would replace it with gold, or we'd go to another country that, who do you even go to, right?
And that's Brent's argument. Like, it's like, where do you go? Like everybody wants to do an alternate. Like, where, if you're not going to do it in the U.S., what, are you going to put it in? Like what, the German currency that we're in a recession, right? You want to put it in the yen? You want to go buy the stock? You want to buy the Japanese stock market right now? You want, what's your alternative?
Exactly. There's no real good place for anybody to go. I mean, Europe, but that's a
They're
joke.
already in a recession. They're already in a recession.
And two, their debt's way worse than ours. And two, they don't have their military is our military. They don't even have a military.
They don't even have oil. They're like, if it wasn't for Russia, they'd be out of oil.
These aren't even countries that are self-sustainable at this point. They are only sustainable because we exist. And a lot of people don't like that. They don't like to know that, but it is just true. Their militaries are the only reason Russia hasn't taken them over by now, right? Is because we're over there. We spend trillions of dollars on these countries and everything else. So this is a stabilizing factor of currency that it has nothing to do with the currency and the economy or the trade itself, but instead it's just pure faith. And you can call it fear, but it's true. Now, the major currency as it flows around the world, since the world is flat, you're talking about money that no longer is domiciled within the individual countries, right? Money moves rapidly and it flows all over the place, but it needs safe harbors. That's why every time there's global collapses, guess what happens? Assets in the United States go up. Why? Because people from Asia, Europe, South America, everywhere start pouring money into it. In fact, you can look at the inflow in America. It's just more and more and more and more. It's risen. After 2008, it's gotten wild how much money has come in the last 3 years. After COVID happened. More money came into the United States. More people bought real estate. More people bought everything they could get in. The United States is a safe harbor for world capital.
Think about if you're a foreign investor and you want to hedge your currency of your home country. Where are you going to hedge it? The only place you're going to hedge it is the U.S. You're not going to be in China and say, "Oh, I want to hedge my yuan. I'm going to go to Japan and buy yen." Like, no, you're going to hedge it by buying U.S. dollar or U.S. dollar backed assets, or that's why you see a lot of Chinese investments in real estate. But because that's just basically a way of them playing the currency game. They can put their money into U.S. assets and hedge their bets on their currency from their home country.
Now, I am going to be a little bit contrarian here, and Brent didn't talk about this, but I'd be interested to get his take. Maybe he's listening and he'll chime in. But a couple risks that I see. Number one, yes, if we destroy some emerging market currencies, that's certainly bad for those countries. And even if you look at like in Argentina, not an emerging market at all, but you look at them, their currency getting devalued and inflation going like just through the roof. That's basically destroyed their currency. Not good for us because they own a lot of dollar denominated debt and other assets. And when they can't repay their dollar denominated debt, well, that's money we're losing. But they're a relatively small country. What happens when China or Japan sees massive inflation and can't repay their dollar denominated debt? Well, now suddenly that has an impact on us. So that's number one. Number two, keep in mind that a strong dollar in general is good for the US, but not overall. There's one segment of the US that a strong dollar is really bad for, and that's global companies in the US that export. Companies that export take a big hit when the dollar is strong because it costs a whole lot more for foreigners to buy our products and for us to ship and transport our products and sell our products overseas. And so if we see that the dollar strengthens tremendously, what that's going to do is that's going to make it really tough on U.S. exporters. And we're going to see a lot of U.S. companies that are global companies start to suffer. Now, will they suffer as badly as other countries? No. But still, when you start seeing companies like Coca-Cola and Microsoft and whoever else, global brands in the U.S. start to suffer because it becomes so expensive to sell their products overseas or for foreigners to buy their products, that's going to be bad for our economy. Likewise, tourism in the U.S. is going to take a hit. It's going to be really expensive for people to bring their foreign dollars over the U.S. and exchange them and travel
Johnson
in the U.S.
does talk a little bit about this, and basically his response to that is that someone like China, so China is a gross net exporter, the biggest, and we are the biggest net importer in the world. And so if you get the out of whack where that balance is off, then China corrects it. Like they manipulate their currency. Russia's right behind them. And that basically that's why his theory was compelling to me, where I was like, I I don't see a scenario where our dollar goes down, because if we try to, print money and bring our currency down, then China is going to look at it and be like, we can't have that happen. We can't have like the balance go off too much, because to your point, our export and imports are all of a sudden like we're making less money and things are getting more expensive. So they're going to do the same thing. They're going to start printing their money and bring their currency down. And then it's a a, a snowball effect that once we do it, everybody else is going to do it. So that's kind of what he sees, is that whenever the US does something that has one effect and the rest of the world follows suit, because otherwise it would throw off the balance, and those countries would go up in smoke.
We could stop shoring up these other countries. I mean, you got to remember that one of the largest reasons we printed so much money was to shore up banks across the world with dollars. So in our mass printing, a huge amount of that money never ever went to the United States. We were printing money and we were giving it to other countries to shore up their banking system with dollars.
We're the only country that can print base dollars, right? Like no other country can print base dollars, and we can theoretically choose whether we want to give it to people or we don't.
It's our number one export. It's the number one thing we export, and that is dollars.
So if we stopped, that would be wild. I mean, you would essentially, these countries would literally lose the value.
Well, let's break this down a little bit, because Mauricio talked about this a bunch of episodes ago. That basically, if you want to create money, the bank's lending creates the money, right? But you still need base dollars to create that money. So, like, if the U.S. all of a sudden decided, "Hey, Germany, we're not allowing you to create any, like, we're not creating any more base dollars for you to for your country to lend out," like they can't create more money. They can take the base dollars and then they can lend that out and then create money on top of that. But without the base dollars, they can't. So we could literally turn it off for other countries. Now it would be, suicide in other ways, that, that would be basically declaring war on a country. But theoretically we could.
We also have the ability to make our own debt disappear. I mean, the Fed can buy up massive amounts of debt, stick it on their balance sheet, and now suddenly our debt has disappeared and the debt of other currencies is increasing.
Yes. So when you look at it, once again, that's why I think the whole thing, whether the dollar, we have a lot of tools to fight against the dollar being too strong or being less. And even when you talk, let's say, take China for an example, as a perfect example. Well, by the way, the total amount of things that we're exporting for China has absolutely tanked over the last 6 years. China's middle class has grown. They're not nearly as competitive. We're now in a lot of other countries besides China. Including Mexico and all sorts other countries, and their skilled workers are better too. But still, even if you took that is just one country. That's the great thing about the United States. It has options. So we have options to go to other people. They don't. They have to come to the United States. So when you look at it, we can offset a lot of these things. Now, it doesn't mean we're protected from everything. That's not what I'm saying. But what I am saying is there's so many tools the United States has, as long as they are the best. That's the key, though. As long as all these other countries are in this mass mess, we have a lot of tools. If we got to a point where the United States is in a big old mess, but then Europe is super strong, they don't got debt, they're producing a ton, their economy's growing, their currencies are stable, that's really bad for us, especially because they are the second largest currency holder in the world, or the currency used. So that would obviously be bad, but that is simply not the case right now. We are the nicest house in a crappy neighborhood.
And Jay, you brought up that one. I want to touch on your first point there. I would, where you talked about what happens when these countries basically default on their debt. I would say there's probably very few countries that they don't hold as much debt or don't owe us as much as we owe them, if you know what I mean. Like most countries hold a lot of US debt. And so if something happens to them and they can't pay what we owe them or they owe us, then I'm guessing we usually owe them more than they owe us. So I think we're going to be fine on that, wouldn't you say?
That's a really good point. Yeah, that makes sense.
Jay, I just want to share a screen real quick if you're watching on YouTube, because I think this gives a good example of what the issue with this high debt burden happens. This I'm looking at. I couldn't blow it up. I apologize, but this shows the U.S. dollar strength relative to the Japanese yen. And as you can see, back in 2021, a dollar, you needed about 103, 104 yen per dollar in 2021, and now that's gone up basically 50% to about 155, which means if you're a Japanese factory, a Japanese business, and you took out debt, which a lot of folks do, obviously, and your monthly payment was $1,000 a month. Well, back in 2021, that was about 104,000 yen, 103, 104,000 yen. And now, fast forward only 3 years later, that's now 154,000 yen. So your debt payment just went up 50%. Can you imagine if your mortgage went up 50%, or if you have any kind of business loan and you thought you were paying $1,000, which you still are paying $1,000, but because you have to convert it into your currency, we don't have to think about that because we are the reserve currency. But in other countries, they have to convert their debt into US dollars first in order to pay it. And so my debt payment was $1,000 a month a couple of years ago, and now it's $1,500 a month. I mean, that's a huge increase, and that's what causes issues. And then those companies go bankrupt. Those companies no longer can survive, which causes an economic crisis in that particular country. Now, to be fair, the yen is also, practicing yield control. They're trying to keep their interest rates artificially low, so they're printing yen to buy dollars in order to keep those interest rates low. But that just illustrates the issue of foreign. We don't have to think about these things, right? We don't have to think about when we take out a loan to buy a mortgage. We just have a mortgage in US dollars. But imagine if you had to pay your mortgage back in. Be great if we could pay back in Argentinian pesos, because if our mortgage was in Argentinian pesos, then it's great, because when I convert every month to get the pesos, well, they're a lot cheaper now than they were last month. And so my rent keeps going down, or my mortgage keeps going down. But for most of these countries, it's the other way around. Their mortgage, their debt payments actually going higher because of the relative dollar to whatever their currency price is.
Yeah, I talk about this a lot, where in the US, we need to worry about inflation, and we talk about inflation, and it's probably the biggest buzzword we've had in economics in the last couple of years. If you live in another country, you still have to worry about inflation, because they're printing currency in every country in the world right now. So you have to worry about inflation in your country. But in addition to that, it gets compounded by your currency losing strength to the dollar, because a lot of things are dollar denominated in around the world. And so, yeah, it's a really good point that we worry about inflation. They worry about inflation times two.
So after going through this exercise, my question is, are you guys more worried now that not so much we talk about like we're doing all this crappy stuff in our country that eventually people are going to lose faith in the dollar, and the dollar is going to get devalued, and that's going to be the end of the dollar? Are you more worried now after this discussion that the dollar is going to get too strong and we're going to go up to a DXY of 150, 200, and that's going to lead to some sort of monetary reset, and that's going to be the actual concern?
Can I just say, this is a good segue into a point I wanted to make, and that is, this is just one point of view, right? And I think one of the issues I think a lot of people fit into, and I try my best not to, but people get stuck in their echo chambers, and they follow whatever thesis that supports their thesis. And what I love about this is that it may be, maybe it's not, maybe this is your base case if you're listening to this, but if it's something that you hadn't thought about, if you're in the camp that you think the dollar is going to zero and whatever, this is just another point of view that I would encourage you to listen to. That's why I like to listen to all different perspectives. I listen to Peter Schiff, who thinks that the dollar is going to zero tomorrow and the gold is going to go to $20,000 by the end of the year.
And here's the link to buy gold from his.
Yeah, exactly. So I love Peter, but I like to look at the opposite position. Just like I love to, like, when I listen to the news, it's like I don't believe anybody, so I like to listen to
Yeah, but Peter and Brent, like, both of their theories point to very high gold, right? Like, it doesn't matter.
Yeah, but for different reasons. Yeah, they keep having a friendly bet every year about where, if gold is going to be higher or lower. And again, I think it's more about timing. I think Peter believes gold will be at $1 million an ounce by the end of the year, and I think Brent's is first. actually Brent's thesis was initially the dollar was going to be stronger versus the gold, so gold prices would go down, which actually they did. And then eventually, when this started to end, you would see both the dollar and gold rise. And I think it's because you're going to see, again, the dollar getting stronger just means it's falling at a smaller rate than everybody else. If the dollar is going down 20% and everything else is going down 30%, that means relative to each other, the dollar is going up. But relative to gold, which is kind of another currency, they all might be falling, which is kind of what Brent's point is.
But here's the problem. Gold's still limited. Once we went off the gold standard, so the idea of just, let's just go back to gold. Can you try to peg a dollar in a financial system right now on the gold? That would wipe everything out. Like it would be, the gold is not, the only way we're replacing fractional, our fractional banking system and pegging it back to a gold denominator is if we're eliminating mass quantities of capital within the global financial system, because there is not enough gold to back it.
Or we're defining the price of gold so high.
Well, but more importantly, the banks would never be able to print again.
Yeah, the counter argument to that is just the price needs to be adjusted. I mean, if the price of gold was $100,000 an ounce, and you were now figuring out the price of gold in terms of grams or 1/10 of a gram, or just like the bitcoins, is like is it a Bitcoin or is it a Shitoshi or whatever it's called? Like you can literally
right. But the whole reason we went off the gold standard still holds. Like the governments would never be able to print money again, and it could never happen. But at the same time, and that's the issue I see with this, like this whole like reset. Like, oh yeah, so if we do a global monetary reset, like what do we reset to? Like what are we going to peg it to? What are we going to change? Like what can they change?
Commodities. You can peg it to oil. You can peg it to soybeans. You can peg it to a basket of currencies. You can peg it to
The problem is it was so successful. So think about how much we have to reverse in our world to go back to when we didn't do before the dollar was not pegged to gold. Think about all the progress that's been wrapped up in the last 60 years that has happened because we've had mass expansions of capital and resources. The problem is it was so successful, we would have to fail so hard. We would have to go back to the 40s, like to get to a point where growth from those periods time when we were pegged to hard physical actual commodities was so slow. And so
Let's be clear. We were not pegged to gold in the 40s. They said we were pegged to gold, but we printed a whole lot more money than we could afford to print. And it was literally the only way we were able to win World War II. I mean, if we had formally been on the gold standard and not printed more money than we could afford to print, and we could have this whole discussion about how the government lied to us about how much money they were printing and whether they could afford to print it. But at the end of the day, if they had not done that, we would not have won. The Allies would not have won World War II.
100% Europe would be speaking German.
All right. So before we move on, I now understand why Kyle's hat starts to move right around the 45-minute mark and go sideways, because this Woodford Reserve starts to kick in about 45 minutes into the show.
Let me just say one more thing, and I think it's interesting because you talk about Peter Schiff, you talk about Brent Johnson, you talk about all these different theories of what happens at the end of the cycle, and the interesting thing is that the end looks the same from every perspective. It's just a question of how long it takes to get there and what happens between now and then. But I don't see too many people arguing that this doesn't end with the collapse of the dollar or the restructuring of the dollar or the restructuring of a global currency or the global currencies. Nobody's arguing that. It's just a question of how long does that take and what happens between now and then.
Yep.
Yeah. And as everyone has pointed out, we're still the cleanest dirty shirt in the laundry hamper. And there's a long way off to get there. There's like so many things would have to happen. So
Maybe.
Do we, you can't just throw that bomb in there and not back it up, Jay. But I would say, because we do have to move on, I would say, as I was researching for this, I checked out this, the Fed website, and it kind of tells you everything you need to know, where I don't know if it's yearly or every few years, but they release an update to the international role of the US dollar. And so this is the post-COVID edition. So they did it last in 2023, and they literally go through this whole thing. and show all the reasons why the dollar is strong, why they believe the dollar isn't going anywhere. And there's a few that are concerning, but most of them are pretty strong. But then you get all the way to the last chart and they just sum it up. And here's the index of the international currency usage. And after everything that we've done since 2008, our currency usage has, if anything, gone up, and the euro has gone down. The Chinese renminbi has gone up a little bit, but if you look at its percentage uses on the index compared to the US dollar, we are so far ahead.
It's 1% Chinese renminbi, and we went up after COVID. The whole world shored up in dollars, so this only goes to like, what is that, 2021, where after 2021, 2022, the dollar usage went up and dramatically.
Yeah. So if anything, this dollar milkshake theory eased my fears a little bit. It opened a new fear, or as they say, new fear unlocked, about the dollar getting too strong and there's some currency reset happening. But I still think we got some years to go for that. So any final thoughts? Are we moving on from this?
The only final thought that I would say is, once again, though, I think I go right along with Jay, that I think a restructuring is going to happen. It has to at some point, right? It just can't, and it can't keep going forever. That's literally how it works. So the question is how, right? Like, how do we get there? Like, what is it? And then how do we actually make it through? So is this going to be, cataclysmic, or is the United States going to be in such a powerful position where they're going to manipulate the financial system enough to get everybody back on track and still remain in power?
And just as important as how is when, as we said before, because, if it's 100 years from now, then we don't have to worry about it.
You won't know. Nobody listening. Exactly.
All right. Let's get back to some real estate. We kind of had to talk about this because I've seen it on so many news stations and so many real estate blogs, and everyone just wants to bring it up because there's a story making the rounds about the St. Louis office building that recently sold at a 98% discount. So the building was purchased in 2006 for $205 million. Well, it was recently sold for $3.6 million. So 205 down to 3.6. It was bought by the Goldman Group. Now, this wasn't a one-off is the problem, because there's a lot more stories that are kind of like this. There's numerous examples of office buildings selling upwards of 75% off in cities like Washington, San Francisco, to name some others. So we've discussed the problems with office previously, but nothing to this extent of 98% off or 75% off. So I'm asking AJ, are these sales just outliers? Are the city specific? Or is this indicative of the market as a whole kind of just continuing to slide?
So it's indicative of the market as a whole continuing to slide. You now have regional banks that are shoring up more capital to offset underperforming commercial real estate loans. And this is something that is going to most likely continue as long as interest rates remain super high. So this is something that, in fact, their banks are they're all upping their total reserves as they're looking at their portfolios. And they're saying, we need more cash. We want to make sure this all works and we get through this okay. So it is not something that is unknown. It's not something that's like hidden. It's not like when we had the housing crisis where people were like, no, housing won't go down. It could never go down, right? No, this is totally opposite. Everybody's like, yeah, we got to shore up stuff and everything because a lot of these mortgages are underwater. Now, this largely, when we're looking at what the reason behind it is, it's the size of debt. So we had cheap money fueled the valuations of these assets. As these valuations went up, more people that bought them were taking on more debt to buy at these new valuations. Well, commercial real estate, we get our value from net income, right? And a leverage on that, which we call a cap rate, is an expression of value. So if a cap rate is low, that means the price of it is worth really high. And what that is that's low is a denominator off the net income. So low cap rate, high value, high cap rates, low value, right? Well, interest rates change what we can buy. So as an investor, a cap rate doesn't include debt, but as an investor, it does, right? Because I can only afford so much. Well, when you have 0% interest rates, those values went really, really high. Commercial real estate holds huge amounts of debt because they're so big. These are huge office buildings. Well, when you go from 3% interest rate to 8%, that just completely wipes out the ability for anybody to afford those assets anymore because the net income no longer exists, because the interest rate change wipes out any net income you would ever get. So now you are cash flow negative, right? And that is
And just to put a finer point on that, I mean, imagine a building that 5 years ago or 4 years ago was generating $100,000 in income a month before paying their mortgage. That same building, that building might have been paying $80,000 a month in mortgage at 3%. That same building today is still making $100,000 before their mortgage, but now that mortgage is no longer $80,000. Interest rates have gone up. That mortgage is now $150,000, and they're still making the same $80,000 or $100,000, so they can't pay the mortgage anymore.
Yeah, and this is a lot of this what we see in certain asset classes. The thing that we look at office buildings, because this valuation problem associated with debt is happening in office right when they're also having a problem with tenants. So office buildings are having a valuation problem because of debt and interest rates at the end, though, of a cycle where they've had lower rents, higher vacancy. So office buildings are getting hit left and right. You can deal with, if you are making money and you're doing good, right? Lots of times you can figure out how to get solutions to overcome this. Lots of banks will work with you to extend it. You have to put more money down to lower that overall cost of payment. But if your net income was already dropping and then this happens, there's no way to even get out of it. There's no way to turn around. And so you just see a collapse in the values in those types of assets, where other commercial real estate assets, we're not seeing that, right? So multifamily, the distress that we've seen in multifamily, frankly, I believe were just bad deals. Like, these were not deals that people should have been doing, right? And then the debt is a real issue. It's a real problem on multifamily and every other asset. But we don't see this escalation in vacancies and drop in rents like we've seen in office buildings. So it's a more manageable problem, although for some, it's not. They got in a bad
and multifamily is I believe the only reason that it's actually staying up there as far as distress is just because multifamily was such a solid asset class that banks were willing to max out the debt, right? So like when you're getting 80 loan to cost loans on these properties, sometimes over 100 LTV, after, including your construction costs, then when you are a lot more sensitive to debt, like office buildings, no one's getting that kind of level of debt.
43% on average.
Yeah, exactly. So every other commercial asset class isn't getting that level. So they are more sensitive. So when we see these like really high interest rates, that's the reason the multifamily's feeling it as much as everyone else, even though it might be a more stable asset class.
Yeah, in storage, we don't get that. We're putting 35% down, right? And it's, we've got large margins, even stable cash flow, but we can't load up debt like you can in multifamily. So the multifamily, it really is a function of the debt where we're seeing struggles. And other commercial asset classes, whether that's storage or other ones, light industrial, we really have seen no issues whatsoever. They have long-term leases, high demand. But when you look at storage, it happens to be regional, overbuilt areas that have to refinance or sell. Because storage, especially guys, when you're out of so anybody listening to this, there's a difference between an office building in San Francisco, New York, or these major cities collapsing. The reason why that's such a big deal is because those are markets where values don't collapse. Like when you're in second, third, fourth tier markets, those values are very tied to interest rates. So they go up and down. They'll really move. And we can see a 300 basis point spread on cap rates in a third tier market easily, or a 400 point spread, where if you go to Southern California, you may have a 50 point spread. That's it. Like they don't move that much. Why? Because funds that have all cash, or they're getting their money cheap from other ways, or have locked it in a long time ago, they'll still come in and buy it at the high values. So when you see collapse in values like that, that's why people go, holy cow. Now, that doesn't mean though, right? Once again, that's still concentrated within a large asset class. So commercial real estate overall, it has to do with the two sides. Debt is a problem for every single asset class right now. Uniform, that doesn't matter, right? but the ability to pay that debt is very much separated amongst the asset classes. So what asset class is performing, which one's not, how much debt overall they've taken, and how that works. And we're seeing a very big difference in how that's playing out. But the debt is always a correlating factor that we're seeing these problems with today because of refinance and sell. And the new buyers or the new banks or the new loans are in a new world of interest rates, and they have to adjust the value because you have the debt coverage ratio. And can this afford to pay it? Well, it can't like it could when debt was free. And so everybody's readjusting expectations and values predicated on that across all commercial real estate.
With the interest rate, like everybody was hoping this year for interest rates to start dropping, right? We started with 7 different interest rate drops, and now we're down to 3. And honestly, I'm starting to finally hear people start to talk about maybe having some interest rate hikes, which it's never really, it's kind of a whisper stuff, but people are starting to think about maybe now we're not going to get any rate cuts at all. We're going to get some increases. So that just doesn't bode well for any of these commercial loans, because that's part of the hope that people were banking on, was like, hey, we're going to have some cuts here in the next year or so, and that's going to help us out with the refis. And
well, everyone's basically reset their business plan to 2025, right? The whole commercial saying was survive to 25. So they've said, okay, we're going to go through 2024. We're going to start to see rate cuts in 2024. And then 2025 is going to be business as usual. Things are going to be on the downslope. Banks are going to be confident that we're not seeing any rate hikes, that we know the trajectory the Fed's going to go. We know the trajectory of the economy. And that's when banks open up their liquidity. Well, if the Fed keeps saying, well, maybe we'll raise, maybe we'll cut, maybe we'll do that, then banks are going to be like, maybe we won't loan. So that's not good for any asset class.
And keep in mind, I mean, this isn't just a banking issue. I mean, AJ and I were talking offline a couple of days ago about this idea of doom loops. The fact that when a big section or a big building or a big part of town shuts down, that impacts the social network around that building. So AJ mentioned a building in St. Louis that traded at like 95, 96, 98% below where it last traded. It last traded 205 million. It was an AT&T building. I think it just sold at like $3 million. The fact that that building is empty means that there's a whole bunch of people in that building that aren't shopping in that area, that aren't eating in restaurants that area, that aren't frequenting the parking garages and the entertainment and all of those things. So then all of those retail businesses start to take a hit because now you have an empty building. Then when those retail businesses take a hit, I was reading about, literally there's a Panera Bread near that building in St. Louis that shut down a few months ago. And this Panera Bread was like the place where all the lawyers in town, like around that building, would eat. And once the Panera Bread started to shut down, or once the Panera Bread shut down, all these lawyers started walking in a different direction to go eat at restaurants in a different part of town. And that Panera Bread shutting down basically shut down an entire section of St. Louis. And so we get this doom loop, this spiral, where people leaving causes other people to leave. Nothing to do causes no people to come, and no people coming causes nothing to do. And cities shut down because of this. And so
and values start to drop. And so then you get appraised based upon comps. So that value drops. Now another value drops. So then you go to get refinanced, and they're like, no, your appraisal came back lower because we see 4 other comps over here where they sold lower because they were in distress. So now I'm not going to loan to you as much. Well, now I'm in distress because I had a loan on here, but the valuations have gone, whether I'm still making money or not. And this loop is what ends up being.
Well, the loop happens basically until one of these big boys steps in and they see the value, right? Like there's somebody who, okay, 205 million. There's somebody steps in and buys it and okay, 3.6. Like I'm in there. And then they do something like, as AJ just mentioned, Detroit, we discussed Detroit offline, where basically Detroit, what happened is what was it, GMC, like basically just decided, hey, like we already have a lot of resources in the city. Let's buy this one trophy asset in the middle. And not only that, we're going to buy the trophy asset. We're going to buy all the stuff around it too. And we're going to start forcing it to gentrify. We're going to put in a ton of security, because once the prices come down low enough, then it makes a lot of sense for an investor like us to come in and say, hey, we're going to put a lot of money into this. And in that case, it was billions of dollars. And because the opportunity versus the cost that it's going to be is now flip the scales. And we're going to start that, the doom loops, loops work both ways, right? Like the doom loop goes down and then like if you put all the money back in, it's going to work its way back up. If all of a sudden people are coming in there because they have to go to work there because somebody bought that and revitalized that office building, then that's going to create demand for a Panera Bread, and a Panera Bread's going to open up, and then it's going to loop its way back up on the way back up.
As somebody who grew up in Baltimore 40 years ago, I can vouch for the fact that it doesn't always come back. And sometimes people do buy trophy properties and properties around them and put in lots of security and spend a lot of money. And what you have is you have a tiny little section of the city that might do well for some period of time, but it doesn't necessarily spread. It doesn't necessarily catch on, and it doesn't necessarily reverse the doom loop that the overall city is seeing. And again, I don't have a lot of examples.
Well,
But
every American does, because we've all lived in small towns. I mean, you're taking like 80% of American population lived in a small town that is dead. I mean, every small town in America now that is dead is a doom loop. That's exactly what it is. It's a lack of demand. There's no values. Capital can't go there. It just goes. And then all of a sudden you're sitting here going, what happened to the city? And it's never coming back. Like some of those cities.
And this is the number one reason. So when we do our market analysis every quarter and we decide, okay, is this a good market still to be in? What new markets should we consider? There's a reason that we have a threshold, right? Where we say, hey, we're only going to invest in an MSA that is 500,000 or more. And the reason for that is if it's an MSA that's lower than 500,000, then let's say Walmart is the major employer there. Well, Walmart decides, or even better, let's say Tesla's the major employer there. And then all of a sudden, Elon Musk decides, hey, I get in a fight with the governor, and I'm going to move my factories out of that area to somewhere else. Well, 10% of the workforce is gone. You're like, oh, it's only 10%. But that 10% creates this doom loop that we're talking about. And then all of a sudden, it's spirals all the way down, and your apartments are getting foreclosed on. So the problem, that's why you want to stay in these large major cities where a single employer is just kind of a drop in the bucket, where you can, yes, so a major employer, we lost 100,000 jobs. Well, there's 5 million people. So it's not that big a deal. So yes, if you're a local investor and you can keep your finger on the pulse and you can kind of, be really in the weeds and moving in and out, it'll work for you. But if you're looking to invest out of state and bigger stuff, then it's always better to do these cities where major shifts aren't going to create this doom loop.
I'm going to go on record. I bet you if we fast forward 5-10 years from now, this is going to be a freaking steal at 3.6 million. It reminds me of my old law firm here in Long Beach, California, the one I started my career at. Same thing back in the 1997, whatever that crash or maybe around that's before I started. So it was like in the mid 90s. They bought their building down in Long Beach for like $5 million, down from whatever huge number it was, because it was just nobody wanted to buy. They bought it for $5 million, and then within like 10 years, it was already worth 40, 50 million bucks. So I'm not saying it's going to go back to 205, but I guarantee you, let's rerun this video in 5 to 10 years, I bet you these guys are going to do just fine.
Well, I do think this is a bit of an outlier, though. Just this building, of course, because there's a reason we don't see 98% off very often, if any. And the reason is that you need a major use change, right? That building that we're talking about, it had been vacant since like 2017 or something. And there have been multiple fires, and basically you almost had to pay someone to take that, because the way the building is now and the use for it is now doesn't work. So you're going to have to either, like, I wouldn't be surprised if they just implode it and build something on the ashes, because like that's the price that they're getting it at. They're getting it at basically, okay, they're paying 3.6 million. It's going to cost them, $300,000 to scrape it, get rid of the thing. And so that's what they're buying the land for. And so that's that's how I read this as. It's, they're not buying this building, they're buying the land.
Well, we have this happens to us in markets that I look at, and a lot of people, they're looking at it, well, this is a steal deal because you got a high cash return, and this is so far below replacement cost. And I look at it and I'm like, why do you think that's a good thing? Because if it's below replacement cost and that building burns down and I have to replace it, I'm buying it at $30 a square foot and I have to replace it at 100. The reason it's below replacement cost is because revenues that come from those buildings aren't high enough to justify it. That means every time I have to replace a door, every time I have to fix something, the cost associated with that, my ROI is going to go down because I can't achieve revenues that are high enough, right?
Your insurance is based on replacement costs too. So
And so when you look at it, it's like those aren't actually markets I want to be in. And while it looks like a steal deal, there's also a reason though. If revenues are not pushing up value, in fact, they're stagnant or going down, then why do I think my value is going to be inherently more? There's actually a reason for it. And so those could be very, really big, dangerous signs that you're in a doom loop. Whereas it's not worth replacement cost because the revenues that asset would even achieve are no longer achievable. This is what happened to retail and big box stores. Why did they fail? Because there was nothing to generate revenue from them that would justify even remotely the cost anymore because the business model that ran those things was so small, it was just these stores and it no longer existed. So all of a sudden you had these empty boxes that were worth astronomical amounts and were like basically the same, grade as bonds were, go to nothing.
fair enough. Any final thoughts, guys? Or we ready to wrap this up?
So, what other cities do we think we should be avoiding or we should be buying into? I mean, who would have thought that this would happen in St. Louis? I hadn't heard any risks around St. Louis, and now suddenly I'm hearing like basically half the city is dead. What else should we be concerned about?
I mean, obviously, there's some California cities that are having issues in office, in particular.
That's Northern California. That's not really California.
Okay, so northern. That's there's only two directions, north and south. But I also say, like, just because you see stories like this doesn't necessarily mean the city should be avoided at all costs. It might just be areas, right? Like,
Or assets.
right. Well, so that's what that's kind of what I meant by areas too, because there'll be areas that have a large office presence that are going to get hit. Like this is like, oh, this is I know in Houston, like there's certain areas where it's just all office buildings, and those areas might have trouble. But if you're in these major cities, then theoretically that those prices will just come down to the point where they'll get reused as something else. And I don't necessarily say it's a huge like we're seeing a huge shift that these cities that were historically stable cities are all of a sudden going to show up on the watch list, I guess.
Well, if you owned multifamily next to this St. Louis office building,
Yeah, but no one's been buying, like no one's been saying for the last decade, like, oh, we got to go to St. Louis. St. Louis is a great place to invest in multifamily. Like the metrics in St. Louis were never great there anyway. Like it was just kind of
It's mostly a single family market. If a lot of people made a lot of money in single family in St. Louis.
I think though that the thing that you got to look at for us is always core demand. So when I look at it, we are looking at long-term trends and core demand, meaning that I don't want short bursts and, oh, this company's coming here. That's amazing. Like, okay, that may or may not happen. Those are trends, right? I want to see long-term growth in a few areas. I want to see population growth, income growth, right? And a few other areas like that these are core things that actually drive demand: employment, population, and income. Those things create the demand for the use of everything that we do, all real estate. And if you have years and years and years of this consistent growing, and you have the spread that is growing and it's growing, this is organic demand that will drive value for the use of real estate. And I think that's really important. And we need to look at it. And that can come in a lot of shapes and sizes of cities, right? I've seen this in cities that are 150,000, that they've been doing this for 20 years. And they have great, consistent, good demand, good jobs, right? And if you stick with those long-term trends, you can usually overcome the short term.
fair enough. I think that's a good point to end on. We doing a top 10, Mauricio?
Let's do the top 10 bourbon whiskeys.
Oh, I would need more time to prepare for that.
how about the top 10 poker hands that Kyle played the other night when he was playing poker with some high rollers?
Well, it wasn't high rollers actually, but I did get invited to a random poker night for like local school dads. And I was like, well, Jay, for those who don't know, Jay, didn't you play in the World Series of Poker a couple times?
Final table, baby. Final table.
And so I haven't played poker in decades. And when I played poker, it was against hockey players. So like playing against like these doctors and lawyers and all these, my kids' dads here. I was a little bit more concerned about my ability to play poker. So I hit up Jay and I was like, hey Jay, like, give me some pointers. So we sat for an hour and Jay went through poker strategy with me, but I came out on top. I ended up doubling my money, a little bit more than that, even after paying the host for food and beer and stuff. So yeah, that was, I appreciate that, Jay.
I've got a good top 10. Maybe we can have the audience participate. But top, our 50th episode is coming up. Maybe the top 10 locations of where we should film live our 50th episode.
Ooh, that would be good if we could throw it up there and people could vote for it.
Let's do that next week. Let's get some comments down below. I'm shooting for Vegas, or actually Tennessee's not a bad. Nashville's not a bad location either. Cancun, Cabo.
Yeah, when we got 2 East Coast guys, 2 West Coast guys too, so they're going to be button heads. So it'll be interesting where it comes out.
That's right.
My top 10 was just related to our first topic, where it was the top 10 most traded currencies by value. But I'll run through this real quick. So obviously the top 2, US dollar, 88% of all transactions has one side with a US dollar. Next closest is the euro, where that's 30%. And then I will let you start guessing after that. What's the third one?
The yuan, the yuan is probably the next one.
I'm going to say yen.
Japanese yen, number 3. Number 4, guesses?
The renminbi.
Yeah, the renminbi or the yuan.
The sterling.
Yeah, the pound, euro.
Number 5 is the renminbi. I always have problems with that. Number 6, Australian dollar. Number 7, Canadian dollar. Number 8, Swiss franc. Number 9, Hong Kong dollar. And number 10, Singapore dollar.
There you go.
Thought that was interesting. I don't want to go through the change between the years, but Canadian dollar sneaking in number 7. Gotta respect there. All right. Should we do a fun question? So I also was thinking too, it got me concerned about the US if there is some sort of reset. And I was like, where would I move to if there was all of a sudden an issue with the US and you had to flee somewhere? So luckily we have the means to probably expatriate somewhere. So I'll start with Jay. Where is what country would be first on your list if you had to flee the US?
So the problem is I don't have citizenship or the ability to get citizenship anywhere, but assuming that weren't an
don't
issue.
get technical. Just pick a country.
Italy.
Italy? Any reason, or you just like the food?
I like the wine. I like the food. I like the small towns. I like the culture from what I know of it.
Do you realize how bad of a shape Italy's going to be if you had to flee the United States?
Well, okay, let's just say you all of a sudden you run a crypto scheme that goes badly and you're wanted by the US government, so you have to flee, but every single country is a non-extraditing country.
Yeah, Jay and I were talking about that the other day. I'm trying to help Jay on that front. Oh, sorry.
We're not talking about our criminal enterprises.
All right, Jay's pick is Italy. He says he could live full-time in Italy. Mauricio, where would you pick?
Well, I mean, obviously for me, it's not that hard. I mean, I'm a citizen of Chile, so I would just go down to South America and spend some time down in Chile, especially the south of Chile. So,
but if you could pick any country, you would pick Chile.
I'd pick Chile, yeah, for sure. Yeah, Chile is like
because I wouldn't pick Canada.
No, I would pick Chile for sure. That's my number one. If you gave me one choice, it'd be Chile, and then living in Belize for a few years. Belize isn't too far behind, but I would say Chile because it's a no-brainer. It's like in the middle of nowhere.
I think you're on a better track with the Belize thing. AJ, what do you got?
This is really tough. So, because I can think of
AJ just loves America so much he can't even fathom the concept of him having to leave.
Well, you got to think about it like this. In America, I can live in tropical, I can live in tundra, I can live in all others. Most of the other countries you pick, you have to kind of go with whatever it's got right there.
Not in Chile. The Chile is the longest country in the world. You got desert all the way in the north, and you got the Antarctica all the way in the south.
AJ doesn't have to worry. He lives in Idaho. I mean, nothing bad is. They can take care of themselves.
I'm moving to Idaho.
Nobody's going to care what I do.
AJ talks about how all these great places that we have. Oh, we could live tropical. We could live in ski areas. We could do all this stuff, and then he chooses Idaho to live in.
Dang straight.
All right, you got to give me one country though.
Switzerland.
I knew you were going to say that. I knew you fit. You would fit right in there. You got no like if you went down to Chile, you'd stick out like a sore thumb.
The only thing I said, like, because actually, fun fact, I did live in Switzerland for 4 months. So it does, I'm not going to say get old, but you do kind of become numb to it. Like the whole, like, oh, you're driving around and these big, beautiful, snow top peaks everywhere. At the bottom of it is this beautiful lake and stuff. And like for the first couple of weeks, you're like, oh my God, I can't believe I live here. This is amazing. And then it kind of just becomes like, this is where I live. So
can I do a shout out to Ouray, Colorado? Because Ouray, Colorado is the Switzerland of the United States, and it looks just like Switzerland. Like it literally has those high peaks with the mountains and the lakes at the bottom. It literally looks like you're driving through the Swiss Alps if you're in Ouray, Colorado. So yeah, save yourself the money. Just go to Ouray.
All right. Well, so obviously I was prepared for this because I knew what the question was going to be. So I looked up practically what the fastest growing GDPs in the world were. And then I looked at the list of the top 10 and I noticed that on the top 10, we have Fiji, St. Lucia, Bahamas, Maldives, Barbados, and Monaco. And I was like, all of those, fast GDP growth, pretty good beach towns. I think I would pick one of those.
Monaco, dude, we should do our 50th episode in Monaco. How awesome would that be?
I've never been to Monaco.
I've never been to Monaco. It's on my list. It's I don't know, AJ, if the plane will make it to Idaho. Will your private plane make it to Idaho?
To Idaho? Yeah.
But if not, I would go to Idaho. I would go to Idaho. I would go to Monaco in a heartbeat to record our.
Well, no. So what's perfect? He said he could make it to Florida. So what if it goes to Florida? Would it make it from Florida and I would meet you in Florida with Jay, and then we could go from there. Would that make it?
Great plan, guys. I like it. I'm down.
You would have to find an island in the middle of we'd have to find an island in the middle of the Atlantic to land and refuel.
Okay, Mauricio, can I just say how impressed I am that Kyle slipped in another top 10 and you didn't even.
That's right. 2 for the price of 1.
In another top 10 on you, man.
He also shipped me a bottle. He's the one who got me the bottle of the Woodford so that I would not realize that
he wouldn't care.
All right, let's go with some plugs. AJ, what do you got for us?
Check out the podcast Self-Storage Income podcast, and we've got some Nick Lavery. He's this vet. It's awesome. It's coming out next week. So yeah, you guys should check that out.
Jay, I feel like you got something very important that you want people to come out and check out. So I think you got a plug on the ready.
Yeah. So tomorrow night, or I guess this comes out tomorrow morning. So tonight, Wednesday night, April 24th, I'm doing a multifamily underwriting webinar. So if you want to learn how to underwrite multifamily properties, go to jscott.com, and the top link will let you register.
Make sure you check that out. I learned everything I know about underwriting from Jay, so it's
just the opposite. I learned everything I did from Kyle. So if it sucks, it's all Kyle's fault.
Actually, I'm not even gonna. My daughter's got a recital at the same time, so you're on your own, buddy.
I can just make up anything I want, and there'll be nobody there to know I'm just making stuff up.
That's true. Mauricio, what do you got for us?
My most viral reel was about LPs being pissed off at GPs. And so next Monday on Real Estate Syndicator Live, I've got Jeremy Rauld showing up to talk about LP, sort of syndications from the LP perspective. So if you guys want to join us at 11:30 on Monday, realestateSyndicatorLive.com, highly recommend it because Jeremy Rauld is considered one of the top LP investors. So he's going to give us his perspective on how LP should be figuring out how to deal with all these GPs who are screwing things up.
Well, there's two completely different LP perspectives, right? There's the LP perspective that we're investing pre-2017 and all the way through this. And then there was the ones who jumped in the last 2 years. So I feel like those are two perspectives. All right. As always, I'm going to plug my wife, Badash Investor. Check her out on Instagram at Badash Investor, YouTube, Badash Investor. Yeah, that's all I got, guys. We all back next week?
All back next week.
Cruise all together. Perfect. How'd you do, Mauricio? How was the Woodford? Did you make a dent in it?
Look, that's like a 2/3.
There you go, of the mini bottle.
It was good though. It was good. I just wish I had a hat to move my hat around. Your hat did not move. What's going on there?
It must have been. I did the clear. I didn't go with the Woodford, so it must have been.
That clear has like no alcohol. Clearly,
No sugar, no carbs.
It's actually 40. It's 40%. It's not the so 80 proof. It's not Woodford is 90 proof. So it's, yeah, you're right. Not quite as much, but still quite a bit. All right, guys. Well, I guess if we're all here, then I will. Well, actually, I got to point out my drink's gone. I don't know about anyone else, or a little bit. I got one sip. Time to go hit the head. I will see you next Tuesday.
See you next Tuesday, guys.
Later.